So we're glad to have him for the next half hour. Mark McQueen is the former president and CEO of Wellington Financial. Mark, it's been so good to finally have you on the desk. And I know you were watching SVB from the moment those cracks were emerging. Let's just talk about that. How you initially saw it playing out versus here we are today. It's part of this North Carolina family dynasty.
To think that you can be a family and own a bank in the United States
Yes.
for 100+ years, 3 generations, to be the largest family-controlled bank of 4,700 banks, and to have had a market cap of $8.5 billion on Friday, and then to announce at 1 a.m. this morning that you're buying a business that had a market cap of $25 billion just a few months ago. It's incredible. And I think the FDIC has done a good job of delivering what it wanted, which was stability, for sure.
And because of your parallels of starting Wellington Financial and then ultimately being part of CIBC, which had this innovation banking.
Almost the same thing going on here.
Exactly, and you would compete with SVB on certain deals. What does it mean that SVB essentially is gone?
Look, I am hopeful that it has taken on a new form. The fact the brand is going to continue as a subsidiary makes sense, what I would do too. The fact that they're going to try and hire all the people, largely that are the thousands of people at SVB who are very talented at what they do, makes sense. The fact that they paid zero for a $16 billion technology and life science and clean tech book is incredible. But it speaks to, I think, how important it was the FDIC to convey these deposits, about $55 billion, and these loans, about $70 billion, onto a balance sheet that they trusted. And clearly this management team at First Citizens has done several M&A deals since 2009. They bought CIT, was approved last year, and they've clearly demonstrated that they have prudence. The fact that the CEO calls themselves a conservative bank may scare some VCs who actually need a bank to take risk.
Yeah.
If you're going to back my early stage $5 million revenue, cash flow negative company, but they'll have to work out that messaging. Today, I think the point was to convey stability for the regional banks, the small banks who've seen their shares down 80% in the last 2 weeks. And then worry about fine-tuning the message with the VCs weeks from now.
What is the conversations the Canadian bank executives are having right now, either whether this is still a strategic area of the market that they want to go after,
well, first of all, they're saying,
there's a big
oh
problem.
my God, I had no idea it was free. And that is no small thing, right? I mean,
well, free now, right? We've learned that there could be issues down the road.
The FDIC's agreed to share losses going forward. The fact that they paid zero for a $25 billion U.S. business is quite something. And, I give credit to anybody who was bidding on that business in a very short window, knowing that they were taking on risks, right? This institution in Raleigh, which is a tech center, right? There wouldn't be that many better places to bid from. You've got Boston, New York, you've got Raleigh, the technology research triangle, as it's called, with Durham and Chapel Hill. So it makes sense. On the one hand, their investors may think it's a fit, but obviously the size of that business dwarfs the existing First Citizens business. For the Canadian banks, it's open season on $70 billion of loans, right? There's a $40 billion U.S. capital call business, which I would go after if it was me. And then there's another $16 billion of tech and life science loans, which people were competing for a month ago. So, clearly
then do
go
they
after
want to
that.
go after you? Use the word conservative to describe First Citizens. You could also apply that to the Canadian banks.
Look, CIBC bought Wellington Financial 5 years ago because it wanted to have an offering in the space. It is the fastest growing part of the bank in the 5 years that passed. The $11 billion of funds managed, the banks disclosed in that business from zero in 5 years. So clearly, BMO followed, Scotia followed, National Bank followed, TD touched on it, and the Royal Bank renamed their existing division with an X on the end to make it seem attractive and new. Look, there are 4,000 people now available to poach who are good at what they do. It's an opportunity for sure.
But investors are nervous. The Canadian bank stocks are trading at the lowest level since October. They're bouncing a little bit today. There's a broader concern about, things like deposits, which are the lifeblood here. Should investors be nervous about Canadian banks?
Well, go back 6 or 12 months, right? It was the recession. That was the pressure on bank shares, and then it was the cost of funding, and then each bank had its own little story in one quarter or the other about mortgage pricing or growth. And then it was nix, right? The cost with inflation and staff retention was growing double digit, and you weren't getting double digit revenue growth. So that's, I think, what's been going on. The fact that Canadian banks have a very broad-based funding model is going to prevail through the rest of the year, and that's why their shares are not down at all relative to even the money center banks like JP Morgan.
What do you think about where we are right now? You've seen a lot of cycles. Is this going to get worse? There's some concern that this is just the first shoe to drop, and then the next one could perhaps be commercial real estate. You've seen tech rally. How are you thinking about this? Is this something you want to get in front of? Because I know you're opportunistic, and you have a higher risk appetite than some others.
There's whack-a-mole going on right now, and that, I think, is what must concern analysts and regulators, to be honest. The Credit Suisse deal was only a few hours ago, relatively speaking, in the context of a 166-year-old bank or something. And then it was Deutsche Bank a few days later. That we need to stop, right, as a sector, a banking sector and regulatory sector, and for market watchers. Whether you can make money on First Republic today or lose money on Western Alliance is for punters, and there may be some plays there this week. Clearly, this First Citizens deal, they've picked up. They might double their book value for free. So people can make money in those situations without having to be opportunistic or, frankly, even have a high risk tolerance. But it's the Deutsches that are I won't call them black swans because we know that they're out there, but they certainly are those are I think, the icebergs that people can hit this year that impact everything, not just the banks.
And so this falls to the regulators, this falls to the central banks to deal with at a time where they've also got this other thing that they're working on, which is inflation. How do you see that playing out? Which one do you think they're going to ultimately focus on?
Well, the 25 basis point hike a couple of days ago in the U.S. was clearly telegraphing that we are serious. We're not going to just pause here. The fact that a whole bunch of money has gone into
But was it the last?
I don't think so.
Okay.
I don't think so. If one bank screwed up on how they invested their liquid deposits in 10-year mortgage-backed securities, that's not a pox on the Fed's strategy. It might be a pox on a regulatory team in San Francisco who could have done a better job. But, SVB, as it's been disclosed by the media, was already getting mean letters from their regulator about what they were doing with many things, including not having a risk manager for 9 or 10 months, which is ludicrous, right? In a business that has that kind of beta to it. So I think the Fed's got to stay on, and as an investor, I expect they're going to stay on this war path. And frankly, if the price of golf balls is up 10% in a month and a half, inflation isn't done yet, right?
Yeah. Well, but if we get an economic slowdown because of this bank weakness that trickles to other parts, inflation you'd expect would kind of take care of itself.
It would take quarters upon quarters of banks clamping down on lending. And frankly, if you're not worried about your balance sheet and you got to grow your business to take care of the cost of your expenses going up, banks are incented to actually keep lending.
You think that will happen? I think that's the question: is will the wheels of the economy grind to a halt?
I do not see that on the banking side at all.
All right.